Welcome to all of you. Today we are going to talk about a very interesting indicator that was inspired, according to its creator, by the mathematical formulas present in the book Paul Wilmot on quantitative finance. This book is a reference in the field of quantitative finance and provides a wealth of valuable insights on how to model and analyze financial markets. Inspired by this rich resource, the creator of today's indicator has applied some of these mathematical formulas to develop a tool that helps us better understand market behavior. The indicator is composed of the following parts. The white line represents the change in the price of an asset over a given number of periods. It is a measure of how much the price has changed during that period. The light blue moving average helps smooth out fluctuations in returns to identify long-term trends. The orange line represents an even smoother version of the previous moving average, helping to reduce noise and highlight the most significant trends. The red and light blue areas help visualize when returns deviate significantly from the average. This can be a signal to traders that it may be a good time to buy or sell, depending on the direction. To install it, search for it in TradingView under the name Returns Model by Tenozen and add it to the chart. In the parameter menu, we have the following. If long on is false, the indicator will calculate and display linear returns. If long on is true, the indicator will calculate and display logarithmic returns. This means that it will show the price changes proportionally, better reflecting the real behavior of the markets. I recommend you leave it on. The use arrow period parameter refers to whether one or several time periods will be used to calculate the returns. If use arrow period is enabled, it means that an array or a list of different periods will be used. This allows to analyze the returns on multiple time scales. If use arrow period is false, it means that a single fixed period will be used. This is simpler, but limits the analysis to a single time period. This option allows you to choose between analyzing returns over a single period or over multiple custom periods. This provides more flexibility and analysis possibilities. If enabled, in the option below, we can set the period we want to use for the analysis. The MA length option refers to the light blue moving average parameter, and the last parameter, smoothing length, is the calculation of the smoothed average, I. A, the orange-colored average. The way to apply it is simple. When the white price line enters the red or light blue shaded areas, this indicates that the price could be about to turn around or reverse its trend. These colored areas represent volatility and deviation of returns. The other two lines mark trend changes. When the white line crosses the other two lines, it signifies a trend change. Conversely, if the white line crosses the other averages to the upside, we could consider it a sign that the price is rising. In summary, the returns model is a visual and analytical tool that can be a good complement to your investment decision-making process. It can help you gain a deeper understanding of the behavior of your favorite assets.